Well, let's get more on the U.S. markets with my next guest, Michael Cuggino, President, Pacific Heights Asset Management. He joins us live from San Francisco. It was a pretty robust session yesterday, a little bit of a mixed market, but still Apple and Facebook really providing, a lot of that optimism. Tell us, are we seeing a more robust earnings period that's going to make us all feel better about the U.S. economic recovery?
Let's hope so. I mean, we're still probably only a quarter to a third in, but I think the results have been pretty promising so far. You've got a lot of companies meeting and beating expectations on the bottom line in a variety of what were perceived as maybe two highly priced growth industries. You mentioned Biogen and the pharma and biotech area. Gilead Sciences was another one that came out with positive news today. You mentioned Facebook and Apple, so technology. So I think what you're seeing is companies meeting and beating in a variety of industries. And also, somewhat surprising, many companies are providing positive sales outlooks and beating on the revenue side. So that's been a little bit of a change, and that's a positive development and bears watching going forward.
Okay, so that is positive. Maybe a little bit more lackluster is inflation, right? We're still seeing it not really budge up a bit, and in fact, home prices were pretty much stable, but didn't really reflect growth in the U.S. economy. So that means for the average American household owner and consumer, they're not seeing their wealth grow, at least not from their homes. What does that say about the rest of Main Street?
Well, home prices over the last, several years have grown, but they're coming off of big lows and sell-offs. The inflation story here is somewhat mixed. I think it depends on who you talk to. Certainly, based on the statistical government numbers, inflation is still very tame. There's slack in labor, there's slack in employment activity. U.S. economic activity levels are still relatively low. We have anemic GDP growth, and the velocity of money is still very low and has been declining. So those factors all argue for lower inflation. On the other hand, the risks you worry about are an inflation surprise. Money velocity picks up or lending picks up, especially to small businesses, real quick. The employment market continues to, accelerate. Those things could drive inflation quicker and sooner rather than later, which would put more pressure on the Federal Reserve to act more quickly on interest rates, which could cool off, stock prices and earnings as you go out. So a little bit of risk there, too.
Yes, but if you're an income investor, what do you do then?
Well, as an income investor, we would advocate being relatively short to intermediate and probably high-quality names, strong balance sheets, on the belief that we believe market interest rates could be volatile at some point. Our view would be we're in the beginning of a long transition period of monetary policy from very easy to maybe neutral to ultimately tightening, but it's going to take a while. And within that period, you may get some volatility, and we would advocate investors to be smart and lower risk there, being able to take advantage of quicker rolling over balances as rates go up. So I think the thing there to be is flexible. We currently run a flexible bond portfolio that we've got a duration of about 5 or 6 years, and it's about 3/4 high quality. And so that's where we are on the curve right now.